In this video, we're diving into the Foreign Tax Credit, or FTC, a powerful tool for U.S. taxpayers living or working abroad to avoid double taxation. With over 9 million Americans abroad and global business on the rise, the FTC, the Foreign Tax Credit, is a must-know for expats, digital nomads, and international investors. In this video, we'll explore what it is, how it works, eligibility, benefits, limitations, key considerations, all grounded in the latest data as of November 2025. So let's get right into it. The Foreign Tax Credit is an IRS provision that allows U.S. citizens and residents to offset U.S. income taxes with taxes paid to foreign governments on foreign-sourced income. Since the U.S. taxes worldwide income, unlike most countries with territorial tax systems or residency-based tax systems, Americans abroad face a unique risk of being taxed twice, once by their host country and again by the IRS in the United States. The FTC, outlined in IRS Publication 514, prevents this by crediting foreign taxes dollar for dollar against your U.S. tax liability. For example, if you earn $50,000 in Spain and you pay $10,000 in Spanish taxes, you can reduce your U.S. tax bill by up to $10,000, assuming the income is foreign source. This applies to income like wages, dividends, or business profits earned abroad, making it a lifeline for expats in high-tax countries like Spain, Italy, or the UK. So how does it work? You calculate the FTC using Form 1116, filed with your U.S. tax return, your Form 1040. The credit applies to foreign income taxes, including those on wages, self-employment, or passive income like interest and dividends, but not value-added taxes, VAT, or property taxes. You must prove the foreign tax was paid or accrued, using documents like foreign tax returns or bank statements. The credit is limited to the lesser of the foreign tax paid or the U.S. tax due on that foreign income, calculated as a percentage of your total U.S. tax liability. For instance, if your U.S. tax on $50,000 of foreign income is $8,000, but you paid $10,000 abroad, you can claim only $8,000 as a credit. Any excess can be carried back 1 year or forward for 10 years per the IRS, providing flexibility for fluctuating income. Now let's talk about eligibility for the FTC. It's straightforward as a concept, but there are nuances. So you qualify if you're a U.S. citizen, resident alien, or non-resident alien with U.S. sourced income, and you've paid or accrued taxes to a foreign government. So the most common case is you're just a U.S. citizen living abroad, making money abroad. Maybe you have a local job in Madrid. So how does it work if you have a local job in Madrid or a local job in Toronto? Maybe you're Canadian-American dual citizen and you're still living in Canada, earning a Canadian income, but the U.S. wants a piece of it. So the idea is the income must be foreign sourced. So determine where the work is performed. That's what determines if it's foreign sourced or local sourced, where the work is performed, not necessarily where the payment comes from. It can get complicated. There are more straightforward situations where you work for an employer and you're in the office 9 to 5. But if it's a remote job, things do get a little bit more complicated. But as long as you have foreign sourced income that's being taxed by a foreign government, the taxes you pay to that foreign government are the credits that you're going to use on your U.S. tax return. There might even be a situation where all your income is foreign. If maybe you're early in your career or the majority of your income is foreign, right? So these foreign tax credits can end up being huge amounts of money. So doing it right is important, because if you're paying 50% tax in Italy or Spain, you might be paying, six figures in tax or more. And this becomes a foreign tax credit against your US taxes. The benefits are substantial of the FTC, which really aims to eliminate or at least reduce double taxation, saving thousands annually. If you're in a high tax country like France with income taxes up to 45% and your US tax rate is, let's say, 37%, the FTC ensures you don't pay both, okay? In our 50,000 Spain example, the 10K credit could wipe out your US tax liability on that income, leaving you with no additional US tax. It gets more complicated as you have more assets and you get wealthier. But for someone earlier in their career, it's a relatively simple process. Second big benefit is it's more flexible than the Foreign Earned Income Exclusion, which caps at around 130K. It excludes only earned income, not passive income like dividends. The FTC applies to both earned and passive income with no cap, making it ideal for high earners or investors. For example, a retiree in Portugal with $100,000 in US dividends taxed at 20% in Portugal can claim a $20,000 credit, offsetting US taxes. Third, the carryover provision, 10 years forward, 1 year back, helps in years when foreign taxes exceed US liabilities, like in low-income years. Finally, the US has tax treaties with 67 some-odd countries, including Canada, Germany, Mexico, etc., ensuring smooth FTC application by clarifying tax jurisdictions. You can also check out IRS Publication 901, which has some more details. By the way, if you want help with your US taxes as an expat, there's a link in the description where you can book a call with us. You could be speaking to us as early as this week about how to optimize your US taxes. And we have tax attorneys that we recommend, CPAs that focus on taxes for Americans abroad. So link in the description to book a call with us if you feel like you need some help. Moving on with the video, for global entrepreneurs, the FTC can pair well with pass-through entities like LLCs. And if you run a US LLC from abroad like Uruguay, a place with a territorial tax system where you're paying no tax on foreign income, you may find a way to pay minimal local taxes where you're living, reducing the FTC claims. But any taxes paid on local income in that country qualifies. So for example, if you're living in somewhere like Paraguay, right? Paraguay is not going to tax that income if it's foreign earned income. Any business you do locally in Paraguay, you might pay a little bit of tax on, which would create some FTC claims, some money to work with for your FTC. But if Paraguay is not taxing the income, you're not paying taxes, so you're not creating a credit. And so it makes your situation a little bit more complicated. Oftentimes when you live in a territorial tax country, if you're living in Spain, Italy, whatever, you have a pretty complicated tax situation. But if you live in a zero tax place as an American, you can't escape US taxes, but at least you live in a place that's not taxing you locally on that side, so you only have to worry about your US return. And then you can also leverage things like the Foreign Earned Income Exclusion in conjunction with living abroad in a zero tax or a territorial tax country. So now let's address some of the drawbacks. The FTC's complexity is a major hurdle. There are detailed calculations. You're splitting income into categories and passive income and earned income, separate limits. There's all different nuances that we don't have time to get into in this video. And once you have carryovers, if you have, you can add carryovers every year and it's valid for 10 years forward. So you're constantly having to maintain this carryover balance and tracking them. And that's something to think about as well in terms of complexity. Other challenges include country-specific issues. In nations without U.S. tax treaties, determining foreign tax eligibility can be a little bit tricky, requiring local tax expertise. Currency fluctuations affect credit values. Taxes paid in euros when the dollar strengthens may yield a smaller credit, so always keep the currency value in mind. Another big drawback or challenge is the IRS's increasing audits, so we hear on expats. They're targeting the FTC claims. They want to make sure that things are done right, especially for passive income. I've seen blog articles to this extent. So just keep in mind that this is an area of attack by the IRS. If you're in a low tax jurisdiction, like maybe you're in the UAE or something with no income tax, the FTC could be rendered irrelevant, pushing reliance on the Foreign Earned Income Exclusion, but again, that's capped. So there's always going to be some level of U.S. taxation for the most part as a U.S. citizen. And if you're an LLC owner, sure, that's going to be helpful, but might end up being tax neutral if it's a pass-through entity. Just really depends on your sources of income and what is foreign income, what is considered local source in the U.S., requiring detailed calculations and meticulous records. So who benefits most from the FTC? Expats in high tax countries like Spain or Canada with incomes over 100,000, they're going to have a lot of credits because they're going to be paying a lot into that high tax country system, and they're going to be earning a lot of FTC credits. So the FTC is really most valuable for people paying a lot of taxes to a foreign country because they're living in a foreign country the majority of the year and they're a tax resident in Spain, in Canada, in a country like that. And retirees, we've made a bunch of videos on our channel specifically for retirees, people with pensions from the US, and how do pensions work when you live abroad. And we have other videos dedicated specifically to that. But yes, the FTC could be a part of that strategy if you're in a country that taxes your US pension. In summary, the foreign tax credit is a vital tool for US taxpayers abroad, offsetting foreign income taxes against US liabilities to avoid double taxation. It offers dollar-for-dollar credits, applies to earned and passive income, and supports carryovers, making it more flexible than the Foreign Earned Income Exclusion. Expats in high-tax countries, LLC owners, and retirees can benefit from the FTC, but there are complex calculations and a lot of reporting to be aware of. So it has its challenges, but it's well worth it if you do it right. Pay attention to the tax treaties that we have with other countries. Pay attention to your carryovers, enhanced tax planning for expats. You really want a CPA or an accountant or a tax attorney that focuses on U.S. expat clients because it really is its own rabbit hole and not every accountant is familiar with these things. So find a good U.S. expat focused accountant. And again, if you need some help, MyLatinLife, we can absolutely help. Link in the description to book a call with us, get on our calendar, and we can assist with all things U.S. taxes and being an expat living abroad. And if you enjoyed this video, give it a like, subscribe, hit the bell for more tax and expat tips. Share your thoughts in the comments. Have you used the FTC? Are you exploring other tax strategies? We'd love to hear from you, and we'll see you in the next video.